Good afternoon, viewers, and welcome, Tony, to our November 2025 edition of the Market Update. Tony, markets have continued to move along at quite a nice pace. However, there are a few speed bumps in the roads appearing, and we can discuss some of them at our investment committee meeting yesterday, which we'll go through today. But yeah, what are your views at the moment, Tony, on a couple of the inflation figures not being as good as expected, and as a result, we've had a few delays in implied rate cuts.
Yeah, well, if we're just talking Australia to start with, Vaughan,
Mm.
I'm just wondering. Yeah, everyone likes to think Melbourne Cup Day, we're going to back a winner of a horse and get a rate cut at the same time, so I walk away very happy and not just hungover the next day. But it's I when you actually had a look, I mean, a lot of the inflation numbers have come out because when you consider the cost of goods have gone up because the cost of power has gone back up. You're not getting the power subsidies anymore, so the cost of producing that avocado or selling those peanuts at the market, etc. So when the cost of everything has actually gone up, and those costs are always going to be put back onto the consumer. So even coffee per kilo has just gone through the roof. It's nearly doubled.
Yeah.
So as an example, just the coffee bean. So that is, if the cost to produce is so much more, they haven't gone doubled in price, and that's all going straight to their bottom line. If the cost to produce is so much more, that's going to be passed on to consumers, and that's what drives inflation. So with the energy subsidies coming off, when you have Minister Bowen turning around and saying, well, what we'll do is we'll just organise to have 3 to 4 hours of free electricity during the day for people. Well, you can't do that, because what do you think energy companies are going to do? Just go broke? They're going to
Yep.
pass on that cost of the free energy to people who consume energy at night, and when the families produce the most amount of energy, or consume, the most amount of energy. It's first thing in the morning or late at the evening, unless you're
Everyone's
working
home.
from home. So,
Yeah.
yes, I wasn't overly surprised by it, but I think the key, Vaughan, is, and it's I was asking in the investment committee meeting yesterday, when does this frenzy? I've just got an email here from Kogan, up to 70% off, and you click frenzy, sale ends, but apparently Black Friday's in a couple of weeks. But I've got click frenzy from MJ Bale, click frenzy from Kogan, click frenzy from Charles Twight. So it's just like, I'm sure I hadn't
It's
subscribed to all
Black
these.
Friday is really just a whole month, apparently.
Yeah, that's right. But consumer confidence seems to actually be up as much as inflation was up, and we didn't get a rate cut.
Yeah. Yeah, that's right. Yeah, and there still seems to be. I mean, the liquidity situation seems to be tightening a little bit, but there's obviously plenty of money circulating, and the inflation number has gone up, but it's only slightly run. So 3.2% was the last read. So it's still above the RBA's goal, but it's clear that at least under the government at the moment, that they're not in any rush to keep rates coming down, and we probably think with fair enough reason that
No, I
it needs
agree.
to come crashing down.
No, so I think just there's an entire generation that got used to low interest rates over a decade, but those low interest rates, I think people were forgetting, was due to a financial crisis.
Yeah, yeah,
Yeah, so originally, so they had to stimulate the economy after a financial crisis, which
yeah.
in all honesty
That's
was
right.
actually caused by
Yeah,
bad government and fraud.
yeah,
No, and I'm talking all over the world. Didn't matter what colour ties they wore. So,
yeah.
but I think though,
Yeah,
too, is that when you've actually got financial planning 101, doesn't matter actually what you earn. Turn up to work, you got 12% going into your super fund. So you just turn up to work and work through to retirement, and you've got a multi-million dollar superannuation package. If you've got 20 or 30 years worth of work, you've got that in your ball. And I might not have as many. I'm sure you'll try to kick me out eventually, but but
I'm
then,
sure you'll work more.
invest 15 to 20% of your net income and save 15 to 20% of your net income. That's actually 52. Well, it's actually more, because that's your net income. But basically, if you've got 12% going to super, actually paid for you on your behalf as well, and then live comfortably off the rest. Now, your
Mm,
savings, if you want to put that towards a house or your investors. So if you're earning $60,000, or if you're earning, $360,000, it's the same principle. And you're
mm.
actually going to do
That's right.
okay. And I think that's where the key. It doesn't matter where interest rates are.
Yeah.
If you've got good cash flow and you've got a mortgage, well, why pay off the minimum over 25 years if you can pay off more quicker? So I think that's just a 101, but we did get very used to low interest rates, and there were a lot more sort of, you know, 3 Series BMWs
Yeah.
and the lower end C class Mercs out on Eastern Freeway all of a sudden because people had equity in the home because house prices went up and interest rates were low. But
Yeah.
you
And
still have to
and
pay.
a lot of $1 million loans at 1.8% as well.
Yeah, correct.
That
So
didn't hang around at 1.8%
yeah,
for that long. So
yeah, but we're not seeing a housing crisis. Well, I mean, there's a housing shortage, but we're not seeing a housing crisis in respect to prices tumbling down. We don't have banks jumping up and down. It's not on the front page of the Fin Review or the Age or the Australian that everyone's losing their houses or everyone's losing their jobs or anything like that. So I think Australia's still in a fairly good place. Although our
yeah,
state being Victoria was voted as the worst state to do business, but I won't get too
saw that.
political.
Yeah,
Yes.
I saw that. That's
I mean,
nothing new though.
I couldn't disagree with the article to be brutally honest, and
No.
I like to disagree with things.
Yeah.
Um, yeah,
Yeah.
but I
So,
think I think overall
modest.
we're okay.
Yeah, yeah, and growth has still been modest. So, it's just a case of markets are typically optimistic, and that has continued throughout this year. And I think that there's obviously been really good growth in the ASX from the mid and small cap sector of the ASX, and perhaps it's just a case of this really strong growth over the last 6 months might slow down a little bit based on some of these economic factors, but having said that, I mean, there's still really sufficient liquidity, so there's no major concerns. And over in the US, things are actually fairly similar from an inflation perspective. And yeah, the top end of the US market, the growth just continues, and stock valuations you could say are high, but if you thought they were too high 6 months ago, you missed out on some decent returns in that time as well.
But
So
they actually have come back a little bit. So the Mag Seven. I don't know if you saw it, but Sam Altman from OpenAI was interviewed on a podcast, and the interviewer asked him about how do you have $1.8 trillion of forward spending and you're only turning over $13 billion, and Sam Altman got very defensive and said, well, because the interviewer actually owns a lot of OpenAI shares, who's one of the original investors. He goes, well, I'm happy to buy your shares off you if you want. But they're not locked in contracts. But he said, first of all, 13 billion. We're actually at 20 billion. We're going to be 100 billion in 2 years, and so you start doing all those numbers. But there was a meltdown on any other company that made money off AI between sort of your 6 to 22% in meltdown. So your Microsoft, Nvidia, Apple, Google, all these stocks that have AI. There was all this tumbling down.
Mm,
Once again, what great opportunities. I mean,
yeah.
if did it affect our portfolios? No, it didn't. But
No.
so you did see some of that top end. So, and realistically, when you look at it, was that just people taking some of the gains off the top? There's been some
Probably a lot of
frothy
that, and
markets,
probably a bit,
and
yeah,
this is
probably a
this
bit
is
of
good as
index
time as
selling as
ever.
well.
Yep, that's right.
Yeah,
Some panickers selling off their index funds and things like that. So
yeah, yeah.
overall, it's even if you look at that market, it's not too bad. And even when you had a look at the jobs numbers in the US, it was quite scary if you look at it. But if you look at it in uh, isolation, it could look quite scary. But if you look into it and so when Apple turned around and said they're laying off 30,000 people, everyone was shock horror. AI's taken over. This is Terminator. With the
That's
robots
the
are going to take
presumption when
over.
you see the figures. Yeah, the figures,
Yeah,
just
but
for the record, were basically the job cuts in the US have increased in 2025 quite substantially compared to 24 and 23, and the
but
raw
there was
data looks quite
yeah, but
concerning.
well, as our economist Matt said, though, there was exuberance in respect to hiring at one stage there because we had to hire and then keep it all stakes because it's, even if they weren't busy, you're keeping them rather than taking them off. And Tim Cook came out and he said, well, a lot of this has to do with all of our DEI hires that we did under the last administration, which we don't require anymore, and that we don't need them. So we're making their jobs redundant. Now, it's not as if Apple doing it to save money. I mean, their cash balance sheet is it's got so many zeros in it. It's ridiculous, and good
Mm,
zeros, not bad
yeah,
zeros. And you have a look at their forward earnings and their turnover and their profitability. So they didn't go and lay off 30,000 people because of financial woes. They laid off 30,000 people because they didn't need those 30,000 people. Now
Yeah.
that's not great
And
for
importantly,
those people that got laid
yeah,
off, but that's
but
what
it,
happens in the
yeah,
world.
yeah, absolutely. And importantly, that spike in job cuts does not correlate with unemployment as a percentage. So it's not like all of these people are completely unemployed. You know, they are finding new jobs because the unemployment rate as a percentage has not changed substantially. So yeah, that's one thing we noted in the US. And yeah, in terms of our portfolios and the SMAs, the changes that we've recently made have more been about shifting some funds out of the defensive side of the portfolio and gradually into small caps in Australia, and also into some US small to mid caps. And they have so far done quite well, and particularly our earlier change in the year of the DNR capital out and into the Australian quality has been a really good move. The addition of gold as well has moved quite nicely. But looking forward, we're probably looking to increase our Australian mid and small cap exposure, or even just change some of the funds in there. Um,
Yeah,
uh,
I agree. And I mean, one of the things we're just doing analysis on at the moment is the PE ratio, because in the small caps, of course, or mid small caps, you have what's known as the Nifty 9, and they've got pretty high PE ratios. But at the same time, if you've got a portfolio of stocks where the average PE ratio across the board is actually pretty average and pretty good, even if they've got exposure to Nifty 9 and they've had good results, well, then there's an opportunity to buy that basket, so it's,
yeah,
and I think that's one of the
yeah,
keys. So we're just doing some pretty deep analysis on that at the moment as well.
yeah, and that's just going to be a case of choosing which manager we like in that sector of the market to find those stocks down the lower end of the ASX rather than increasing a large weighting of the whole portfolio. It's more so about just finding the right manager for that allocation.
Yep. I also think, though, Vaughan, there's something else it's usually overlooked in our portfolios because it's the boring side of the portfolios. But I think
Yeah,
our defensive side of the portfolio, whether it's 70-30 or 80-20 or 90-10, the defensive part of our portfolios have actually really performed quite exceptionally well.
yeah.
And even,
It's a good one.
was it last month actually, moving out of UBS cash and going into the diversified income has actually been,
Yeah,
has actually been a great move too.
yeah. Well, it's a good point because we don't actually talk a lot about the fixed interest at all, but the
Well,
largest single
it's fairly
holding.
boring, but it's been great.
Yeah, it's a good
Yeah.
reason because we don't want to put other people and ourselves to sleep. But Janus Henderson is actually our largest single holding across all the portfolios, and for a defensive fund, it's very consistent, but it's still returning 6.5% per annum, which
It's magnificent.
for an income fund,
Well, basically double
it's
the cash rates at the moment, and you haven't got
yeah,
all that credit risk that is sitting in that private credit
yeah,
at the
that's
moment,
right.
out there in the markets. So some of these small private credit funds are very, very scary. But
Yeah,
people are putting their money in there, not based on advice from licensed advisors. That's the saddest part. But anyway, that aside,
that's right. Yeah, yeah.
that aside, I couldn't be more proud of the way our defensive side of the portfolio has actually stood up.
Yeah, Janus Henderson and also Bentham Global Income has also done quite well. So, yeah, just away from the private credit and the tactical income. So we've been quite conservative on duration, which has been a good move.
Yeah,
Um, yeah, but
absolutely.
yeah. Did you have any other points, Tony, about that meeting yesterday?
No, I just it's another one where okay, the markets can come down a bit and go up a bit, and you and I both know that it's not going to go up in a straight line. It is going to be like a kid bouncing a basketball going up a set of stairs. As long as that basketball doesn't get dropped, you're always going to, with time and patience, you're always going to do quite well.
Yeah,
So
that's
and
right.
I think that's the key in the market of what we've actually done. There's no speculation in our portfolio. We've outperformed the peer benchmark by a huge amount. And but the risk, it's not as if we're taking any greater risk in any way to actually achieve that. And I think that's one of the great things.
Yeah, that's right. I
And
agree.
as we
So,
discussed, yes, as we discussed afterwards yesterday too, that there's no use blending a couple of funds together just to get an index return. We'll just get an index fund if that's the case. So it's actually
yeah,
careful selection is one of the most important criteria of what we do.
yeah, that's right. It's about, and that's something that we have done, and we're continuing to monitor is to yes, be diversified, but not be over diversified, because you don't want to pick too many things and then end up with index returns that we've had. So,
Exactly.
yeah,
Yeah.
so that's the changes that we've been making over the last little period are starting to show fruits. So that's really good. But that's about all for November, and we'll see you next month. Thank you, Tony.
Wonderful. And we might even have Jordan back next month. So we can officially tell our listeners, Jordan's usually on here with us, but he became a first time father yesterday. And we've got the photo of little Otis today, and our congratulations to Otis, but obviously Jordan and Lisa as well, as they are new parents and have, as I have a 29-year-old the day after Jordan's first one is born. So it's watch him grow up very quickly.
Thanks, Tony.
Thanks, Vaughan. Bye.
The Kofkin Bond Market Update is a product from Kofkin Bond and Company, which we are an authorized representative of Count Financial. All information in this market update is for education and entertainment purposes only. It is not intended as a substitute for professional, finance, legal, or tax advice. The hosts of the Kofkin Bond Market Update are not aware of your personal financial circumstances. Before making any financial decision, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from the market update. For more information, head to the disclaimer page on the Kofkin Bond website, or you can find resources on the ASIC website and find a registered financial professional near you. In the spirit of reconciliation, Kofkin Bond and Cohers and the hosts of the Kofkin Bond Market Update acknowledge the traditional custodians of the country throughout Australia and their connections to land, sea, and community. We pay our respects to their elders, past, present, and extend that respect to all Aboriginal and Torres Strait Islander people today.